Let's talk about your money now, and our good friend Rob Tetrault, Canaccord Genuity, joining us now. NVIDIA earnings are coming out today. Why is that important to us?
It's important, Clay, because one, it's the most highly anticipated earnings of the quarter. The stock is in complete kind of euphoric rise, meteoric rise over the last couple of years. It's up 200% this year. It's become the largest and most valuable publicly traded company on the planet. It passed Apple, or it's about right where Apple is at $3.5 trillion. They are getting phenomenal revenue growth, unbelievable margins. This is the AI boom, Clay. Everyone wants a piece of their chips, their microchips that are just changing how we live, right? So earnings last quarter beat by about 4 cents. This quarter, we are expecting 75 cents per earning. But I say we, Clay, I'm expecting better than that. The market is, quote unquote, expecting 75 cents. I expect this number should come around 79 or 80 cents. And if it doesn't, expect the stock to come back a bit. It's up so much that if the earnings aren't blockbuster, it will pull back a little bit.
Boy, you have me excited. I got to get a piece of this. Now, Rob Tetrault of Canaccord Genuity joins us again today. Rob, let's talk about earnings and multiple. First of all, explain to all of us, including me, what is an earnings multiple?
Okay, so an earnings multiple is largely how analysts and the market, guys like me, look at a stock and decide whether or not it's cheap or it's affordable. Basically, you take the value of the stock and you figure out how much is this stock worth for every dollar of earnings. It is the price of the stock relative to the earnings. So it's measured by dividing the current value by the trailing 12 months earnings. So if a company's stock is priced at $10 and there's $1 of earnings, that would be a 10 multiple, otherwise known as a 10 price to earnings ratio, or sometimes they'll call it a 10 PE. You might have heard those terms. So if you say, is this stock expensive? Oh, it's trading at a 15 multiple, or it's trading at a 10 or 20. That's the number that they're referring to, price to earnings multiple.
Okay, I get it. So why do some companies trade at higher multiples than others?
Yeah, and this question, Clay, I'm getting a lot this week because of NVIDIA. They just reported earnings yesterday after market closed, and you may recall yesterday I predicted 80 cents of earnings. I was 1 cent off, Clay. It was 81 cents of earning, almost nailed it, perfect. And yes, that stock is trading like at a 60, 65 multiple. It's trading at a crazy high multiple relative to, other stocks like maybe bank stocks or utilities that trade at 10 or 12 multiple. So why would you want to pay more for a stock like that? Well, the one factor is growth. If you get a ton of growth on your earnings, then the future earnings are worth more. So you end up paying more today for that dollar of earning. Different industries trade differently. So typically tech and large growing companies will trade at a higher multiple, and kind of more stable, mature companies will trade at a lower multiple. Banks, utilities, insurance companies, mature companies, kind of in the 10, 12, 15 ratio, and large growth companies, 15, 20, 30, 65 for NVIDIA.
Okay, so several thousand people are watching and listening very carefully to what you say. So what should they do with all this information you've just conveyed?
No pressure, Rob, but you need to tell everyone what to do. I would say, Clay, don't get too caught up in these things if you have an advisor you trust, obviously, because they have a team and they're doing this. But if you're trying to do this by yourself, first off, trade a company, try to focus on companies that have profits. Because if you don't have profits, if you have no earnings, well, there's no multiple. It's an infinite number. That's a zero number. So then you don't even know what happened. Then you're speculating. Try to have some of both. Try to have some companies that have growth potential, like, the NVIDIAs, the Amazons, the Googles of the world, and try to have some that are more stable, banks, utilities, industrial, some of those companies, because they don't all go in favor and out of favor at the same time. So if you diversify your portfolio across different styles, across different geographical allocations, and across different areas, sectors, then you properly position yourself and protecting yourself in the event of one of these sectors or area, having a bad turn in the market. So diversification, trust the experts, and have a plan.